End the year on a very positive note. And what else than to hear Mr. Sunil Subramanian speaking about the status of the market, the economy, and the way forward, and what we as investors should all be looking forward to doing in the coming years. So before we move on, I'll just give you a short introduction about Mr. Sunil, and I will not stand long between you and him. Mr. Sunil is an industry veteran. So he did his schooling in both Pune and Chennai, and he did his bachelor's in chemistry from Loyola, and then his master's in chemistry from IIT Chennai. Then he went on to do his MBA from UK, and he's also a certified associate of Indian Institute of Bankers. So he started his career in SBI, then moved on to Bancom, and then from there, for the last 15 years, he has been very fortunately associated with Sundaram Asset Management Company, and he has held various roles, right, from starting from distribution to now heading the company. He is also on the board of director of Sundaram Asset Management Singapore. So as I told you earlier, as an industry veteran, a lot of us know him from his early stages, and he's a recipient of the Economic Times Most Promising Business Leaders of Asia in both 2018 and 2019. During his 14 years with Sundaram Asset Management Company, the mutual fund has seen a good growth in AUM, which has been actually a manifold growth. And let's all welcome the Managing Director of Sundaram Asset Management Company for our PurplePond's Expert Series Speak. Welcome, sir. Thank you so much for being here on this long weekend, and we really look forward to listening from you. Towards the end, we will have the question and answer session. Participants, we request you to please post your questions in the chat box. We will take note of all those things. We will consolidate, and we will present those to Mr. Sunil so that we can avoid duplication and we can extract the maximum value of his presence over here. Thank you so much. Good day to all of you. Sir, the platform is yours, sir.
Thank you, Sundar. So I'll just share a screen with my presentation. Just 1 minute. So can you see the slide?
Yes, sir.
Yeah.
Absolutely.
So basically, I'm going to cover a little bit of the economy, a little bit of the world economy, a little more on the Indian economy, and the implications for the markets, especially in terms of sectors. Because as many of you know, if you've been experienced investors, right, sectors come before stocks. And obviously, as a mutual fund person, SEBI doesn't permit me to speak about stocks, but I shall speak about sectors to give you a guide as to what, as a mutual fund, our mutual fund managers are looking at and wherein the stock picking will come from. With that, I will just then open up the floor for questions. So, looking at the world at first spot, right? We all know that the COVID crisis came in sometime in January in China, and then February, March, it spread to the world, and that's when the world realized the seriousness of this disease, and the world in the mid-March started a series of lockdowns. So what has happened after that, right, is that there's been a sharp recovery. And I'd like to straight away go into that because you've heard enough. I'm sure expert law conversations like this have been regularly brought to you by PurplePond. And you would have read a lot about what got affected, what happened. But I think that you are all realize that the markets have now gone back to a lot of lifetime highs in many areas. And what is the driving force behind that? And what is the lessons for us going forward? Sundar, is it okay I speak in English fully, or is your audience more Tamil?
Yes, sir. You can speak in English, sir. Perfectly fine, sir.
Fine. So what I wanted to tell you about the world growth. You say you'll get these statistics from World Bank, statistics from everywhere. But I think one key statistics is all everybody needs to look at. And that's something called a PMI, which is called a Purchase Manager Index. Why that's important is because you can calculate PMI for the economy as a whole, for manufacturing and for services. But more importantly, the reason PMI is important is because data of GDP, when it comes out, it's already too late. It's about last quarter, we had 7.5% negative GDP growth. Who cares? It's what is going to happen in the future that's going to guide the returns on your investment. So the PMI is a lead indicator, which means it gives you a clue as to what's going to come in the respective quarters. So more than anything else, even the index of industrial production, IIP, is a useless data because again, it's history. There is a PMI is nothing but an opinion poll of all the big companies' purchasing managers. That's why it's called the Purchasing Manager Index. And what it tells you is each purchasing manager polls to say, are you going to buy more of whatever raw material, semi-finished goods that you buy for your company compared to last quarter or last month? Are you going to buy more? So why would a purchase manager buy more? Purchase manager buy more only if his order book needs more. So it is a very good clue as to what's going to happen in the economy, right? So PMI is probably the single most important economic activity indicator as stock market participants we look at. And what I'm trying to show here is that America, Europe, Japan, in all the three, you can see that after a sharp fall, there is a bounce back in the PMI. And one clue on the PMI is that while you look at the graph and the way it's headed, it's more important that the horizontal line that you see, that is also a critical line because it's 50, right? That horizontal line. Why it's 50 is because it's a pole. So if more than 50% of the people are saying that my future, I'm going to order less, the PMI will be less than 50. If more than 50% say more, it's going to be more than 50. So effectively what we are saying is that if it's below 50, the economy is in a contraction, and it's above 50, it's an expansion. So straight away, I think I've explained this graph. You can see economies went in a contraction, have sharply bounced back to well over 50. And this is across the world, you're seeing three different regions, right? And especially in manufacturing, where you see that the output and the new orders both are going in match, which means that the output is responding to the order book, as I just mentioned to you, right? And the importance is that 86% of the world economies in the month of November had a PMI expansion over the month of October, except for those three countries right at the top, Mexico, Russia, Japan. Otherwise, 86% of the world economies have seen an improving PMI, right? So these are just a summary things which I'm giving you to give a clue at what's happening, right? And then when you look at it in terms of developed markets as a whole, because I showed you the breakup of developed markets, and then you look at China and then other emerging markets. So the light blue line there is the emerging market, right? Excluding China, XC. And green is China. So China got the disease first, China recovered first and stayed ahead. Then you saw the emerging markets got hurt more than the developed markets, but have also recovered faster than the developed markets. So now you can see that all the three lines are well above 50, are rising, are close to each other. That's why the IMF has revised the projection for the next year to 4.4% from a 3.6 which they earlier had, right? So that gives you a good idea that world over, the world is coming back on a growth path. What about India? Now let's go deep into India. That was just an overview of the world. In India, I've given away the clue. We are also riding the recovery. And here, the most important part is that you got to look at the recovery from infections, because the primary cause of this whole problem was the COVID crisis, right? So we must know as a country where are we headed, because you're hearing that Europe there's a second wave, somewhere there's a second wave, right? So for India, you look at it, in September, we peaked in terms of number of infections. Since then, our infection rate is trending down. Only in the middle of November, you saw there's a small spike, right? And then it has started coming down. So we have got the disease well under control with recovery rates around 90%. Most importantly, our black line, which is the fatality rate, is sharply falling and is among the lowest in the world, whereas our recovery rate is fastly rising. So India has got the infections well under control. There is no hint of a second wave in India at the moment. So the direct impact of this, the fact that our infections are less, is seen in the employment data, right? Because all of you recollect when the lockdown happened, what did the data tell you? That people were going away from urban to rural, that they were giving up their jobs. So unemployment was naturally higher. And that's why you saw the peak in unemployment in both urban and rural. And then you saw the recovery has come back to pre-COVID levels. What is the reason for this? It's a threefold reason. First is economic recovery means people have gone back to work. Second, though the migrants went to the rural India, right, from the urban place, the government announced a Narega scheme, additional 40,000 crores, and provided employment to them. That's the second. The third aspect is that we had a good monsoon outlook, and hence the Kharif crop sowing season coincided with the lockdown period, right? So that time there was adequate labor for doing a good sowing. So I shall come to that later. Please remember that. So this is the second indicator that Indian economy is coming back on track very fast. Now you look at another way. See, we have to look at clues. Otherwise, you can set hundreds of data and get lost. The clue is the GST collection. When does GST get collection? When the formal economy reports numbers. Why would anybody pay GST? Only if he sells it, right? So the recovery of the V shape in the GST is one of the key triggers to tell you that the economy is coming back on track and is back to a 1 lakh crore per month GST collection. And the good news is that this growth, which is roughly about 11% month on month, is not uniform across India. So on the left, you have states which have shown 20% month on month growth in GST collection. On the right, you have states which are 0 to 5, 7. So the scope for these states also to step up to a double digit growth means that it augurs well for the future GST collections, right? Then trade, trucks have to move, right? So electronic toll collection gives you a clue on is economic activity recovering. So here you can see electronic toll collection has seen a sharp V-shaped recovery. Next, e-way bill generation. Government is it spending? Because government buying is all through e-way bill, whether it's government to government or government to private sector. So there again, as you can see, government also has stepped up its activity. That's why the e-way bill generation is also showing a good recovery. Then let's look at the freight. Now, freight can be, tolls tell you that cars and trucks are moving. But what quantity of what is moving? Is it just people going on recreation or is it heavy goods moving? So the freight, if you look at it, the four big commodities which are transported in an economy are cement, steel, coal, fertilizer. All of them, as you can see, showing a V-shaped recovery. The actual numbers are given below. Cement has grown 126% YOY, steel 120, fertilizer 112, and coal is flat. So this freight overall is showing a recovery, is indicating that the economy is coming back on track very fast, right? And so coal is linked to electricity consumption, which is also going up, right? And then while in the lockdown, the one thing which benefited, because people are spending more time in front of the idiot box, right? So television ads has obviously shown a sharp increase in this period. Now, to summarize here, so the sectors which are showing good recovery are exports, two-wheeler sales, power demand, GST, which we already saw, passenger vehicle demand, and rail freight. So these are all the V-shaped economic indicators growing. And so we saw the PMI for the advanced countries, we saw the PMI for the world. You see the PMI for India. In India, I have separated the PMI as manufacturing PMI and services PMI. So as you can see, services fell the sharpest, the contraction, because when people are sitting at home, they don't use any services. But when the bounce back occurred, today both are above 50 and both are close to each other. So the services, though it fell more, has recovered also faster than the manufacturing side, right? And I spoke about the migrant labor going to the agriculture. So the one sector, because economy has three sectors: manufacturing, services, agriculture. So manufacturing services, you saw in agriculture, you're seeing that the sowing season essentially June to September. So you can see week on week, the Kharif sowing crop has increased. So much so that in the last 7 years, from 2013, this is the highest the Kharif sowing has been. So what this tells you, not only it provided employment, but the good news is that starting from mid-December, the rice, which is the main Kharif crop, right, has started coming into the market and all other vegetables and everything. So now up to Pongal, right? Pongal is our harvest season in Tamil Nadu, right? So you will see that this crop coming means three good news for India. First is that the agricultural production will contribute strongly to the GDP and will help our negative GDP to turn around. I'll come to that number in a bit. Second aspect, it will mean that inflation comes down, because when the Kharif crop comes into the market, vegetable prices, food prices, already tomato prices have sharply collapsed. You saw that, right? They will start coming down. So that augurs well for Reserve Bank to not hike rates, but maybe one more rate cut also happens. That's the second good news. The third good news is that the money in the hands of the farmer and the rural population, because they'll all get their wages, means that consumption starting from the month of December, January, right up to the summer, we're going to see a strong, because there will be money. Rural demand will drive this whole process. So this is a very good news slide, right? So overall, there is this company called Jeffries, which prefers what is known as an business redemption index, economic activity. And what they are saying, they put in all these indicators that I showed you into one composite number, and they are saying that today the economy has reached 98% of pre-COVID levels. Right? So effectively, we have absorbed the pain of the poison of the COVID crisis, and we have bounced back. Only one caution here. Remember that pre-COVID also, our economy was not booming. In the year 2019-20, our GDP growth was only 4%. So our economy's capacity is to grow at 8 to 10%, which is what it was showing in the 2016-2017 period. After that itself, due to various crises, NBFC crisis and all other crises, it came down. We have reached the pre-COVID level, but the next stage of growth is for us to go back to the pre-December 2017, when the tipping point happened. That is the future growth story for India. Right. So now we come to that number, which is GDP. Right. So first quarter of this financial year, all of you would have seen that number, right? 24% negative. Now this was not just the COVID impact. Please remember, it was also the severity of the lockdown. So India was among the most severe in the world to introduce a lockdown. That's the reason for that. Now the next quarter, everybody expected 9.5% negative. The actual number came at 7.5 negative. That is why there is so much celebration in the stock markets and everything, because the bad news was not as bad as expected. So remember one lesson about the stock market. People will say, even RBI governor said, oh, the economy is disconnected from the market. Markets are disconnected. But that's not true, because you can't look at current GDP and then say stock market is good or bad. Market is expecting the future, and anything which comes better than that expectation means the market will go up, because all market participants are expecting returns only in the future. Pension funds want it in 10 years, mutual fund investors should get it in 3 years, day traders will want it in a few weeks. But whatever it is, it's the expectation of the future. So the market has now revised the GDP growth to 7.5. Consequently, the next quarter, which we are currently in October, November, December, it's still expected to be negative 2.7. So watch out when this number comes out. If it is minus, instead of minus 2.7, it is 1.7, markets will get a pickup. If instead of 2.7 it goes to negative 3.7, then market will say, hey, is our expectation not correct? So keep watching what the number comes for this quarter. But then you see the market is expecting a positive 3.2% GDP growth in January, February, March. Why? I just now said no. Agricultural growth is expected to come in big numbers. In fact, agricultural GDP may itself be double digit, but since it's a small part of our Indian economy, overall, we think that there will be a positive, and then you see a huge 17% number. And that's where the clue lies. Don't get carried away, because all these numbers are year on year. So if it is for this quarter, it is comparing to the last year, same quarter. So the 17% nothing means that this 24% negative, the base has come down. So that base effect is giving a super GDP projection for that quarter. But overall, for that year, that is financial year 21-22, we think that GDP growth could be in double digit, because this year is going to be a very this year, right? Negative. It's still overall going to be 6 to 7% negative because of the 4-quarter impact, right? But 21-22, we could even see a double-digit GDP growth for our economy, and that's what the stock market is factoring in, right? Now, in this future prediction, one of the biggest worries for the market was this moratorium. While the moratorium helped people like you and me who had EMIs to pay to say we won't pay it, the banking sector got punished by the market, because there was a fear that all these bunched up loans at the end of the moratorium, how is everybody going to pay? So do banks have to be prepared for a huge NPA? That's where the RBI came smartly, and instead of doing a third moratorium, which is just kicking the problem down the road, they said this is the opportunity that all good businesses, which were not in default before the lockdown, for them now, instead of asking for the money in one shot, we'll give them 2 to 3 years time to repay that 5 months installment. So that restructuring under Mr. Kamath was called the Kamath Committee recommendations, And that's what it said. It says that 66% of all rated companies in India are going to benefit from this. So who does this benefit? First, the banks, right? Because the fear of NPA was hitting the banks. They were also creating additional provisions saying, we don't know how many of these people are going to pay back. So the banking sector has seen a huge relief. There'll be a lot of unlocked provisions getting released, and the market is also responding to that. I'll show you in a bit. But apart from these, which are the industries where this is going to help? Because that's where the stock market will also see is basically construction, real estate, and chemicals are the three industries which are going to really benefit from this Kamath restructuring. So naturally, the stock market impact on these sectors has been very positive, right? The other thing to bear in mind was that construction is getting a boost, but the longest term story for construction, right? We have to look at it from a perspective of how much this sector is going to drive the Indian economy in the next 2 to 3 to 5 years. So for this, I just taken Mumbai as an example. And as many of you are aware, in Mumbai, the stamp duty was cut to 2%, right? So the kind of incentives which are there, if you just compare from 2007 to now, over the last, say, 13, 14 years, you can see that the EMI to income ratio has dropped from 51 to 29. Phenomenal. It has become that much more affordable to buy a house for the reasons given in the table. You can read it. I'm not going to go in detail. Similarly, a property price to income, earlier 6.3 times was the price of the property to your income. Today, it was the same house, it's only 4.2. What is the reason for this? Incomes have gone up, but interest rates have come down. So this kind of an effect, and it's not just for people to buy houses to stay, it's also for people to buy houses and rent. So if you look at it, if you take the housing loan to buy a second house or a third house or a fourth house, you still get a tax break on that income, right? So your post-tax interest rate is less, and then you rent out the house, you get a rental yield. The difference between that is what you have to put from your pocket today, correct? That difference was 7% in 2012-13. Today, it's only 3%. And as you know, property prices as they rise, this 3% will get readjusted. So it has been never better to invest in a house, right? From an investment perspective. But for this to really help our economy, it's a three-stage process. What is the three-stage process? The first stage is that people who already bought 2, 3 houses, finding it difficult to meet the EMI, will be selling their houses. So first, second-hand house sales will pick up. Second, a lot of builders and developers have already built apartments. They are sitting on surplus capacity. So they will try to liquidate those by dropping the prices and whatnot. So that is the second leg. The third leg is when both those get kind of stabilized, is where new construction will come up to cater to people's needs. And that's the real growth story for India, because for every new construction, the cement demand, steel demand, electrical wiring demand, sanitary tiles demand, sanitary ware demand, PVC pipes, right? Paint. So you get 8 or 10 industries benefit from every house construction. So that's the true growth phase, which we have to give a bit of time. But so the long-term story for the housing and real estate sector is on very solid ground, because we expect a soft interest rate scenario to sustain for quite some time, right? So before I just move into the stock market, I also wanted to give you a clue as to when you look at the various sectors in the market, please remember one thing, right? While the economy and the market are supposed to be correlated, the market tries to predict the future, right? So the stock market is always a lead indicator to the future economic growth. But one of the important things you got to understand is that the people who are investing in the market are not all of the same mentality and the same mind. There's FIS, there's DIS, there's retail traders, there's insurance companies, there are different kinds of people. But even within FIIs, there are hedge funds which are essentially short-term, 1 year, 2 year outlook. There are pension funds which are 10-year outlook. So the market prices, stock prices reflect the weighted average expectations of all those people. And a significant proportion of the FIIs and some mutual funds invest based on the future of India and not whether there's a V-shaped recovery going to happen in the next 3 months or 6 months. So as an investor or as a mutual fund, if you're not aware of who's buying what, I will miss the boat. So you've got to be aware as to what the people who are buying. And as I'll show you later, the recovery in the Indian market is driven largely by FIIs. And why FIIs have been buying so much into India compared to other countries, I'll show you. is because India has a lot of medium-term structural positives. What are these? First, in this crisis, the Modi government has actually used the crisis to introduce a lot of reforms, right? What's the good news about reforms? Reforms opens up the economy. Reforms invites foreigners to come in because they like an open market. Reforms also help India to get capital from abroad. But more importantly, reforms are that which will take our GDP to double-digit growth. But as you know, all reforms are controversial. All reforms are a change. There's always a pain before the gain. You're seeing that in the agricultural reforms which are leading to these farmer agitations. But that's a necessary pain if our economy wants to become a global economy. So the government did a good thing that in this crisis, instead of just giving away money to people, which is what the opposition wanted, they used it to do a lot of reforms which are good for India's long-term GDP growth. I think this is a very critical part of why India is positive, and that's one of the reasons you'll see that FII money has come in. Okay, number one. Number two, it's very important the reforms from a rating perspective because every country in this corona crisis is facing a fiscal deficit pressure. Every country. So the rating agencies are aware that all the world over there are ratings. So India also, which is in the borderline of investment grade, we did these reforms because the rating agencies look not only at how much you're spending. If you're spending too much, your rating is at risk, but the quality of your spending, which means where are you spending the money? Are you giving away through bank loan waiver? Are you giving it away through Narega? Are you putting into reforms and capital expenditure? Because they are the type of items which give you future revenues. So the quality of the Indian expenditure is as important as the quantity, and that's why the reforms are very critical. And we expect India to get through this crisis without meaningful downgrades. So that's the second reason why foreign money is coming to India. The third reason why we expect FDI is already coming in big number, but to go up even more sharply is India has reduced the income tax for new companies from 35% to 17, half. And it is, as you see the comparison with the rest of the world, we are among the cheapest in terms of income tax for manufacturing companies to the rest of the world. So this is expected to drive FDI into manufacturing. Finally, there's also the ease of doing business. Like all these reforms, the roadways, the airports, the infrastructure, the opening up the private sector to the foreigners, opening up the public sector to private sector, all of these help improve India's ease of doing business rankings. And so in the last 5 years, India has seen a 79 ranks improvement in our ease of doing business. So for a foreigner from compared to 2015, he's looking at India is a very different India, which is much more welcoming of the foreigner, right? And the biggest advantage to India comes from the fact that China, which is the manufacturing capital of the world for the last decade, is now experiencing a decline in their labor population. Why? Because one family, one child policy they implemented. So their labor is declining. So this declining labor means that they can't compete for labor intensive projects, whereas India's labor, the black line, is on a rising trend for the next 30 years. Only in 2050 is India's working age population going to the decline. So huge labor advantage to India, and COVID has made the world to say that I don't want to depend on China, not only because of the labor, but because of the crisis itself. So all our companies from various other countries which were manufactured in China today are having something called a China plus one. I don't want to keep only in China. I want another country to hedge my risks. And so that's where India now is in a very advantageous position. And that's why, if you see, the structurally, India is in a very good place, which foreigners are able to see, right? So that's what I want to show in this slide. So now, based on this short-term and long-term view of the economy, let's go into the markets. So in the stock market, what's happening? This is a couple of days old, right? I wanted to point out one thing. That is, this first two indices are the large cap, then you have the mid cap, then the small cap, then the broad market. So if you look at it from a perspective, leave the broad market alone, you can see 3 years, mid and small cap are at negative return, large cap is at 30% positive. But if you come to 1 month, they're fairly equal. And you see 3 months, also they're fairly equal. So what is this indicating to you? This is indicating that slowly the market, from a 3-year perspective, it was more towards safety of large caps. but now it's moving more towards, slightly towards the riskier mid and small cap stocks. So this is the market flow movement. Why? I'll just explain to you. So to summarize this, right, if you take December 17, which was the peak of the stock market, most recent peak, the Nifty has delivered 24% return, whereas mid cap 100 index has given you a -8% and small cap is -30%. What is the reason for such a wide divergence in performance, right? The reason for this is the foreign money. Now, why did the foreign money come? Why? Foreign money comes into large caps largely, right? Why did the foreign money come? Because in response to the COVID crisis, central banks in the developed markets